If you are a senior homeowner living in the United States and you have not yet heard about the new IRS penalty set to take effect in 2026, then what you are about to learn over the next few minutes could literally save you thousands of dollars. Put everything else on pause right now and give this your full attention, because this is absolutely not something you can afford to push aside. The federal government has quietly rolled out a series of new tax compliance requirements that directly affect homeowners who are 62 years of age and older. And the penalty system attached to these requirements is something the overwhelming majority of people have zero awareness of. We are talking about financial penalties that begin at $500 and can escalate all the way into the tens of thousands of dollars, depending on your individual circumstances and how long the situation goes unresolved. The deadline is approaching much faster than most seniors are aware of, and the IRS is not going around sending personal warnings to anyone. If you let this window pass, there will be nobody to call, no paperwork to submit after the fact, and absolutely no way to reverse the financial harm done. Stay with me through the entire video because at the very end, I am going to walk you through precisely what steps you need to take in order to protect yourself and your home before this deadline arrives. So let us go back to the beginning and break down exactly what is happening here and why senior homeowners specifically are finding themselves in the crosshairs of these new regulations. For many decades, senior homeowners across America have had access to a wide range of tax exemptions, deferral options, and exclusions that were purposefully created to help individuals living on fixed incomes remain in their homes without being crushed under the weight of heavy tax obligations. Benefits like the capital gains exclusion on the sale of a primary home, property tax freeze arrangements connected to federal income reporting, and the senior homestead exemption have all served as incredibly powerful financial tools for people in retirement. But here is where things start to unravel. The IRS, along with the Treasury Department, has uncovered enormous inconsistencies in how these benefits are being claimed across the country. Audits conducted over the past 3 years have shown that a considerable number of homeowners above the age of 62 are collecting these benefits without actually satisfying the updated eligibility requirements that were quietly revised during late 2024 and early 2025. And now, as we head into 2026, the enforcement machinery is being switched on at full capacity. The new penalty framework is being applied under what the IRS is referring to internally as the Senior Property Compliance Initiative. This is not some high-profile standalone law that received extensive news coverage. This is an enforcement expansion that was embedded within broader tax code revisions that the mainstream media largely ignored and never examined in any real depth. The initiative requires every senior homeowner who is currently collecting any type of federal tax benefit connected to their primary residence to submit refreshed documentation confirming that they still meet the eligibility criteria. That documentation includes verification of residency, confirmation of age, a current income certification that lines up with the income thresholds established for 2025 and 2026, and in many situations, a newly required IRS form that confirms the homeowner understands the specific terms of the exemption or deferral they are actively claiming. Failing to submit this documentation before the deadline triggers automatic financial penalties, and this is where things get extremely serious. The penalty structure is broken down into 3 distinct tiers. The first tier applies to homeowners who simply neglect to submit the required updated eligibility documentation. This results in a flat $500 penalty that is assessed at the beginning of the tax year, meaning it shows up when you go to file your 2026 return. The second tier applies to homeowners who have been overclaiming benefits using income thresholds that are no longer current. The income limits attached to many senior homeowner programs were actually revised downward for the first time in more than a decade, and a large portion of people who qualified under the previous figures no longer meet the requirements under the newly established numbers. If you continue receiving a benefit for which you are no longer eligible, the IRS will recapture all of those benefits and tack on a penalty of as much as 25% of the total recaptured value. To put that in concrete terms, if you were improperly collecting a $2,000 annual property tax deferral over the course of 3 years, you could be staring down $6,000 in recaptured benefits along with an additional $1,500 in penalties. Beyond that, the third tier is by far the most serious and is triggered by intentional misrepresentation or patterns of repeated noncompliance. Penalties at this level can climb to 35% of the recaptured amount and can also lead to referrals for expanded audit activity covering your entire tax history. Now, I want to make something absolutely clear right here. The overwhelming majority of senior homeowners who are going to get hit by these penalties are not individuals who were deliberately trying to game the system. These are people who enrolled in programs years or even decades ago, qualified at the time they applied, and simply never received any kind of notification that the rules governing those programs had been changed. This is one of the most deeply frustrating aspects of the way the IRS manages program updates. Once you enroll in a benefit program, the legal responsibility for knowing when the terms of that program change falls entirely on your shoulders, even when nobody directly informs you of those changes. The taxpayer carries the full burden of staying current with eligibility requirements at all times. That is the legal reality of the situation, and it is precisely why this is such an urgent matter for so many seniors across the country right now. Let us now go through the specific programs that are affected so you can take an honest look at your own situation. The first is the Section 121 exclusion, which allows homeowners to exclude as much as $250,000 in capital gains when they sell their primary residence, or up to $500,000 for married couples filing jointly. The 2026 updates have introduced new documentation requirements specifically for seniors who have lived in the same home for more than 10 years and are preparing to sell. If you are planning to sell your home during 2026, or if you have already sold it recently, you absolutely must ensure that your records fully support your eligibility as defined by the updated rules. The second program is the homestead exemption, which differs from state to state, but is frequently connected to federal income reporting for seniors above a specific age threshold. Many states have now put income recertification requirements in place for 2026 that are directly tied to IRS filings. If your federal return does not accurately reflect income that is consistent with your exemption claim at the state level, you could trigger simultaneous financial penalties from both directions at the same time. The third is the property tax deferral program, which is offered in many states but is commonly linked to federal eligibility certifications. Seniors who have been deferring property taxes on the basis of fixed income status are now required to confirm that their income still falls within the qualifying range every single year, rather than once every few years, as was previously the standard. Here is exactly what you need to do starting right now. If you are a senior homeowner who wants to protect yourself before this deadline passes, step 1 is to gather every tax document you have filed over the past 3 years. Look specifically for any deductions, exclusions, or tax credits that are tied to your home. If you come across anything connected to a senior homeowner benefit program, circle it and write it down. Step 2 is to compare those claims against the current eligibility thresholds that are now in effect. The IRS website contains updated guidance documents for 2025 and 2026 that clearly spell out the income limits and documentation requirements for each affected program. If you are not comfortable navigating the IRS website independently, reach out to a certified tax professional or a HUD-approved housing counselor. These counselors receive specific training to help seniors work through exactly this type of situation, and a significant number of them provide free services through federally funded assistance programs. Step 3 is to start pulling your documentation together right now. Do not sit back and wait for tax season to roll around. You need proof of your age, proof that the home in question is your primary residence, and current income documentation. For the majority of people, this translates to your most recent Social Security award letter, your most recent filed tax return, and a utility bill or mortgage statement that shows your name and the property address together. Step 4 is to file or amend proactively if you discover that is necessary. If you come to realize that you have been collecting a benefit for which you no longer qualify, the single worst decision you could make is to stay quiet and hope the matter goes unnoticed. The IRS is currently running automated matching programs that are specifically built to identify and flag discrepancies in senior homeowner benefit claims. If you take the initiative to file an amended return or reach out to the IRS before they come to you, your penalty exposure is meaningfully reduced. voluntary disclosure almost always produces far better results than waiting until you have already been flagged. Step 5 is to put the deadline on your calendar and treat it as completely non-negotiable. The compliance window for the 2026 Senior Property Compliance Initiative closes when your 2025 tax return is filed in April of 2026. If you file an extension on your return, be aware that in most cases, that extension does not push back the documentation submission deadline under this initiative. Speak with a tax professional to understand precisely how the timing requirements apply to your particular situation. I also want to address a question that comes up frequently, and that is whether these rules apply to you if you are renting out a portion of your home. The answer is yes, they absolutely do. And in certain cases, the requirements are even more stringent. If you are a senior homeowner who is also renting out a section of your primary residence, whether that is a basement unit, a spare bedroom, or a separate accessory dwelling unit, you are legally required to report that rental income, and it is factored directly into your eligibility for senior homeowner benefit programs. A considerable number of people who have been renting out space through short-term rental platforms have not been incorporating that income into their eligibility calculations for these programs. That represents a significant red flag under the new enforcement framework and is something that needs to be addressed without delay. Let me also take a moment to talk about what happens if you choose to ignore all of this and take no action whatsoever. I have witnessed far too many cases where seniors received a notice from the IRS, did not fully understand what it meant, set it aside because it felt overwhelming, and then months later found themselves confronting compounded penalties with interest stacked on top of everything else. The IRS charges interest on unpaid penalties based on the federal short-term rate plus an additional 3%. What begins as a $500 penalty can grow substantially larger over the course of a single year if it is left sitting without being addressed. And if penalties go unpaid long enough, the IRS holds the legal authority to place a federal tax lien directly on your property. For a senior homeowner whose most valuable asset is the home they live in, a tax lien is an absolutely catastrophic development that can severely impact your ability to refinance, sell, or even transfer your home to your heirs without triggering serious complications. The bottom line comes down to this. If you are a senior homeowner, you have spent your entire working life building toward owning your home, and you have every right to protect what belongs to you. But the only way to truly safeguard yourself in this current environment is to take decisive action right now. Do not fall into the trap of assuming that because you have been collecting the same benefits for years, everything must still be in order. Do not assume that someone from the IRS is going to pick up the phone and give you a heads up before penalties start piling up. And do not assume that because you have never run into trouble before, you are somehow immune to running into trouble now. The rules have changed, the enforcement tools have been significantly upgraded, and this deadline is very real. Make the phone calls, collect the documents, and get in front of this situation before April of 2026 shuts the door on your available options. If this video helped you gain a clearer picture of where you stand and what steps you need to take, please share it with every senior homeowner in your life because there are millions of people across this country who urgently need to hear everything that was just covered here. Hit the like button so that this information can reach more people who need it, and most importantly, subscribe to USA Visa Updates so that you never miss a critical piece of information about the rules and regulations that have a direct impact on your finances, your home, and your future here in the United States. We cover these topics every single week specifically because the government does not make it simple or straightforward to track down this kind of information on your own. We do that work so you do not have to. Subscribe to USA Visa Updates right now and turn on your notifications so that the very next time something this important surfaces, you are the very first to know.